If being wrong hurts your ego, trading will always hurt your account. The problem is not that you are wrong. The problem is that you think you should not be. Most traders enter the market believing that if they study enough, backtest enough, and wait long enough, they will reach a level where they are barely wrong. That belief is dangerous. Profitable traders are wrong all the time. The difference is they expect it. They build it into their system. They plan for it before they ever click buy or sell. Have you ever taken a loss and felt personally attacked? Not just disappointed, but attacked. Like the market singled you out. Like it exposed you. Like it proved that maybe you are not as good as you thought. Maybe you have felt that heavy feeling in your chest after a stop loss hits. Maybe you have questioned your intelligence, your strategy, even your future in trading. That reaction is not about money. It is about ego. Somewhere inside, you believed you were supposed to be right. You believed that if your analysis was clean and your setup was perfect, the market should reward you. When it does not, it feels unfair. It feels like failure. But trading is not a reward system. It is a probability system. And probabilities do not care about your confidence, your effort, or how long you waited for the setup. They only care about edge over time. So let us tell the truth about being wrong. Why being wrong feels so personal. Being wrong in trading does not just feel uncomfortable, it feels personal. And the reason is simple. Most traders tie their identity to their analysis. They tie their intelligence to the outcome of a trade. They tie their self-worth to their win rate. So when a trade loses, it does not feel like a setup failed. It feels like you failed. You do not say, that was one loss within my system. You say, what is wrong with me? From childhood, you were trained to equate being correct with being smart. In school, correct answers meant high scores. High scores meant praise. You were rewarded for certainty. You were rewarded for accuracy. Then you enter trading, and you carry that same mindset. You believe if you study enough and analyze well enough, you should mostly be right. And when you are not, it feels like a threat to your competence. Social media makes it worse. You scroll and see screenshots of winning trades, perfect entries, and big payouts. Nobody posts the 10 disciplined losses. Nobody posts the clean stop out that followed the plan. You subconsciously conclude that real traders are mostly right. But trading does not reward certainty. It rewards probability. The market does not care how confident you were. It does not care how clean your markup looked. It does not grade you like a teacher. It distributes outcomes randomly within the boundaries of your edge. Trading is not a test you pass. It is a probability game you survive. And survival requires emotional detachment from being right. The statistical reality nobody accepts. Let us make this practical. Imagine you have a strategy with a 60% win rate and a 1 to 2% risk-reward ratio. That is a strong system. That is profitable over time. But even with that edge, you are still wrong 4 out of every 10 trades. 4 losses out of 10. So why are you shocked when loss number 3 happens? Why does it feel like something is broken? The math already told you losses were coming. They are not anomalies. They are part of the design. Expectancy is what matters. Expectancy means that over a large sample size, your wins outweigh your losses in a structured way. It means you can lose today and still be profitable this month. You can lose this week and still be profitable this quarter. Short-term outcomes are random. Long-term outcomes reflect edge. Losses are not interruptions. They are built into the system. Profitable traders understand this before they enter. They pre-accept the risk. They pre-accept the possibility of loss. They pre-define invalidation. They know exactly where they are wrong before they place the trade. Amateurs do the opposite. They hope the market respects their level. They negotiate with their stop loss. They move it slightly to avoid being wrong. They take another trade immediately to win back what was lost. They revenge trade because being wrong feels unacceptable. The difference is not intelligence. It is acceptance. Professionals accept the math. Amateurs fight it. The dangerous need to be right. The real danger in trading is not being wrong. It is needing to be right. When a trader feels a strong need to be right, subtle psychological traps begin to show up. You start avoiding valid setups because you are afraid this one might be the loser. You see your model forming, but you hesitate. You wait for extra confirmation. Then another confirmation. Then another. By the time you feel safe enough to enter, the opportunity is gone. Or you take the trade. Price moves slightly in your favor, and you close early. Not because your system told you to, but because you want relief. You want proof that you were right. So you grab a small profit and walk away, even though your edge requires full target to maintain positive expectancy. On the other side, when a trade goes against you, you refuse to close it. You widen the stop. You tell yourself, it just needs more time. You analyze lower time frames, looking for reasons to stay in. You are no longer managing risk. You are protecting ego. Needing to be right destroys discipline. Discipline requires you to execute rules, regardless of emotional comfort. But when being right becomes the priority, rules become flexible. You bend them to avoid pain. You adjust them to protect pride. If your ego is trading, your edge cannot breathe. Your strategy already accounts for being wrong. It factors in losses. It was designed with risk parameters, invalidation levels, and statistical expectancy. Your system expects to lose sometimes. Your ego does not. Your ego wants clean charts, perfect entries, and immediate validation. Your strategy wants consistency over a large sample size. Those two cannot coexist if ego is in control. The moment you trade to protect identity instead of to execute probability, you sabotage your own edge. What profitable traders actually think? Now, let us reframe this. Profitable traders do not think in single outcomes. They think in series. They do not enter a trade thinking, this trade must win. They enter thinking, this is trade number 37 in a 200 trade sample. That shift changes everything. When you think in series, one loss does not shake you. Win does not inflate you. Each trade is simply data inside a larger system. Profitable traders ask different questions. After a trade closes, they ask, did I follow my rules? Was risk controlled? Was my entry aligned with my model? Was my stop placed according to structure, not emotion? They do not ask, did I win? Because winning and losing on a single trade is random within the boundaries of an edge. What is not random is execution quality. You can lose correctly. That is maturity. Losing correctly means you followed your plan, respected your risk, and accepted the outcome without emotional distortion. It means you behaved like a professional, even when the result was negative. That is what separates consistent traders from emotional traders. One is focused on outcome. The other is focused on process. And in trading, process is what produces profit over time. Emotional rewiring. Now we need to rewire how you see being wrong. Being wrong is not dangerous. Uncontrolled risk is dangerous. Undisciplined reaction is dangerous. Read that again in your mind. The market taking you out at your stop loss is not what destroys accounts. What destroys accounts is what happens next. A wrong trade with controlled risk is professional behavior. It means you defined your invalidation, respected your stop, and accepted the outcome. That is structured. That is stable. A wrong trade followed by emotional reaction is account damage. That is where revenge trading starts. That is where you double risk to recover quickly. That is where you abandon your model because you feel embarrassed by the loss. The difference is not the loss. The difference is the reaction. So ask yourself honestly, what do you do immediately after a loss? Do you review the trade calmly and check if it aligned with your rules? Or do you react? Do Do you feel urgency to get back in? Do you feel the need to prove something to yourself? Your first behavior after a loss reveals your level of emotional maturity in trading. If you can normalize losses internally, your decision-making stays clean. If you personalize losses, your behavior becomes unstable. The goal is not to eliminate losses. The goal is to eliminate emotional volatility around losses. How to train yourself to accept being wrong. Acceptance is not automatic. It is trained. First, define invalidation before entry. Before you click buy or sell, you should already know exactly where you are wrong, not where you hope price will turn, not where it feels safe, where your model says the idea is invalid. When that level is hit, the trade is over. No negotiation. Second, accept the stop loss as a business expense. Just like a company pays rent, software, and salaries, you pay for data. Every stopped out trade gives you information about your edge. It is not punishment. It is operational cost. Third, journal your emotional reaction after losses, not just the technical review. Write what you felt: frustration, embarrassment, fear, urgency. Over time, you will see patterns. Awareness reduces impulsiveness. Fourth, track rule following, not just profit and loss. A trade that followed your rules but ended in a loss is a successful execution. A trade that broke your rules but ended in profit is a dangerous reinforcement. Your focus should be execution quality. Fifth, measure yourself in 50 trade blocks, not daily outcome. One day means nothing. 1 week means little. Properly executed trades tell you the truth about your edge and your discipline. Professional traders measure execution quality. Amateurs measure emotional comfort. One is building consistency. The other is chasing validation. If you learn to accept being wrong within structure, your psychology stabilizes. And when your psychology stabilizes, your edge finally has room to perform. Your goal is not to avoid being wrong. Your goal is to be wrong correctly. Most traders wake up every day trying to eliminate losses from their experience. They search for the perfect confirmation, the perfect timeframe alignment, the perfect entry model that will finally remove the discomfort of being stopped out. That pursuit creates tension. It creates hesitation. It creates fear. But the professional shift is different. The goal is not perfection. The goal is precision in execution. Your job is to execute your model with controlled risk and accept whatever outcome follows. If the trade loses within your predefined parameters, you did your job. That is stability. That is structure. Losses do not make you incompetent. Emotional instability does. A loss taken within rules is data. A loss followed by revenge trading, hesitation, or rule bending is damage. One strengthens your process. The other weakens your foundation. When you stop measuring yourself by outcome and start measuring yourself by execution, your entire psychology begins to settle. Reflection questions. Now ask yourself, honestly, how many losses this month were actually rule-breaking? How many were simply normal probability, playing out exactly as your system predicted it might? If you removed ego from your trading, what would change? Would you move your stop less? Would you hesitate less? Would you stop trying to prove something on every single trade? Most traders believe they need more confirmation, more alignment, more signals. But that is rarely the issue. You do not need more confirmations. You need emotional tolerance, the ability to stay consistent even when outcomes fluctuate, the ability to execute even when the previous trade lost, the ability to remain neutral whether you just won or just lost. That is the real edge. If you are ready to stop fighting losses and start thinking in probabilities, comment one word: professional. Not for me, for you. Subscribe to the Daily Trader Mindset if you are ready to trade like a statistician, not a perfectionist.